Hey there, business bosses. Ever feel like you're navigating a jungle of numbers? That's where financial statements come in. These bad boys are like your business's report card, giving you the inside scoop on your financial health. They tell the story of your company's journey from sales and expenses to assets and debts. Think of it like this. Financial statements are the language of business. They help you make sense of all the financial activity happening under your roof. They show you where your money is coming from, where it's going, and what you have to show for it. But here's the kicker. Financial statements aren't just for you. They're for anyone interested in your company's performance. Whether it's potential investors, lenders, or even your own employees, these reports provide valuable insights into your company's past, present, and potential future. So buckle up, because understanding these financial statements is crucial for making smart decisions and driving your business towards success. Now, you might be thinking, who actually reads these financial reports? You might assume it's just a formality, a bunch of numbers that only accountants care about. But oh, how wrong you would be. Well, hold on to your hats, because the audience is bigger than you might think. It's not just a small circle of number crunchers. It's a diverse and dynamic group of stakeholders who have a vested interest in your financial health. First up, we've got the internal users, the folks right there with you in the trenches. These are the people who are deeply involved in the day-to-day operations of your business. That's you, the business owner, along with your management team. You rely on these financial statements to track performance, make strategic decisions, and ensure that every aspect of your business is running smoothly. You need these statements to track performance, make strategic decisions, and keep the ship sailing smoothly. Whether it's planning for future growth, managing cash flow, or identifying areas for improvement, these documents are your roadmap to success. Next, we've got the external users, the curious crowd outside your company walls. This group includes a variety of stakeholders who are interested in your financial well-being for different reasons. Investors. They want to see if your company is a good investment opportunity. They scrutinize your financial statements to determine if your business is profitable, if it's growing, and if it has the potential to provide a good return on their investment. Are you profitable? Are you growing? Show them the money. Investors are looking for signs of financial health and growth potential. They want to know that their money will be well spent and that your business is a safe bet. Creditors. These are the banks and lenders who want to make sure you can repay your debts. They analyze your financial statements to assess your creditworthiness and determine if you are a reliable borrower. They're looking for financial stability and responsible borrowing habits. They want to see that you have a solid financial foundation and that you manage your finances prudently. Suppliers. Your suppliers need to know if you're in good financial shape to pay your bills on time. They rely on your financial statements to gauge your ability to meet payment terms and maintain a healthy business relationship. Solid financials build trust and strong relationships. When your suppliers see that you are financially stable, they are more likely to offer favorable terms and continue doing business with you. And let's not forget about government agencies and regulatory bodies who use financial statements to ensure you're playing by the rules and paying your fair share of taxes. They scrutinize your financials to ensure compliance with regulations and to assess your tax obligations. See, it's a packed house. Your financial statements are not just for internal use, they are a critical communication tool for a wide range of stakeholders. Knowing your audience helps you understand how to present your financials clearly and effectively. By tailoring your financial reports to meet the needs of different stakeholders, you can ensure that your business is transparent, trustworthy, and poised for success. All right, let's dive into the heart of the matter, the four main types of financial statements. These documents are essential for understanding the financial health and performance of any business, whether it's a small startup or a large multinational corporation. Think of these as the four pillars of financial reporting, each one providing a different perspective on the financial status and activities of the company. Without them, it would be like trying to navigate a ship without a compass. First, we have the statement of financial position or balance sheet. This is often considered the cornerstone of financial statements. This statement provides a snapshot of your company's financial health at a specific point in time. It's like a photograph that captures the financial condition of the business on a particular date. It shows what you own, your assets, what you owe, your liabilities, and the difference, which represents your equity. What's left over for the owners? Assets can include cash, inventory, and property, while liabilities might encompass loans and accounts payable. Next, we have the statement of profit or loss and other comprehensive income, also known as the income statement. This is the document that tells the story of your company's profitability. This statement tracks your company's financial performance over a period of time, like a quarter or a year. It's like a video that shows the financial journey of the business over a specific period. It shows your revenues, expenses, and ultimately, whether you made a profit or loss. Revenues are the income earned from sales and other activities, while expenses are the costs incurred to earn those revenues. Then we have the statement of changes in equity. This statement is crucial for understanding how the equity of the company has evolved over time. This statement explains the changes in your equity over a period of time. It details the movements in equity, including profits retained in the business, dividends paid out to shareholders, and other equity transactions. It details how much of your profit is retained in the business, how much is distributed to owners, and the impact of any other equity transactions. This helps stakeholders understand how the company is reinvesting its profits and rewarding its shareholders. Finally, we have the statement of cash flows. This statement tracks the movement of cash both in and out of your company over a period of time. It's like a detailed map showing the flow of cash within the business. It shows how much cash you generated from operations, investing activities, and financing activities. Cash from operations includes the cash generated from the core business activities, while cash from investing and financing activities includes cash flows from buying and selling assets and obtaining or repaying loans. Each of these statements provides a unique perspective on your company's financials, and they work together to paint a complete picture of your overall financial health. They are interconnected, and understanding one helps in understanding the others. Think of them as pieces of a puzzle. You need all of them to see the big picture. By analyzing these statements together, you can gain a comprehensive understanding of your company's financial position, performance, and cash flows, which is essential for making informed business decisions. Section 4, Keeping Score Fairly, IFRS and the Quest for Transparency. Now imagine a world where every business played by its own set of accounting rules. Talk about confusing. That's where the International Financial Reporting Standards, or IFRS, come in. The IFRS is like a universal language for financial reporting, making it easier for investors and other stakeholders to understand and compare companies from different countries. These standards provide a framework for preparing financial statements, ensuring they're understandable, presented in a clear and concise way that's accessible to users. Relevant, contains information that's useful for decision-making. Reliable, free from material errors and bias, faithfully representing the company's financial position. Comparable, presented in a way that allows for comparison with other companies and over time. By adhering to IFRS, you're not just following the rules, you're building trust and credibility with your stakeholders. It's about transparency and accountability, which are essential for attracting investors, securing loans, and ultimately growing your business on a global scale. Section 5, the name of the game, fundamental accounting principles. Now, let's talk about the rules of the game, the fundamental accounting principles that underpin those all-important financial statements. These principles are the backbone of financial reporting, ensuring that the information presented is both accurate and reliable. Think of these as the guiding principles that ensure your financial reports are reliable and trustworthy. Without them, it would be difficult to make informed business decisions or to present a true picture of your company's financial health. Going concern. This principle assumes that your business will continue to operate in the foreseeable future. It implies that the company has no intention or need to liquidate or significantly curtail its operations. This assumption is crucial for the valuation of assets and liabilities. It's the foundation upon which most accounting measurements are made. Without the going concern assumption, financial statements would be prepared on a different basis, which could significantly alter the reported financial position and performance. Accrual accounting. This method records revenues when they're earned and expenses when they're incurred, regardless of when cash changes hands. This principle ensures that financial events are recognized in the period in which they occur. providing a more accurate picture of your company's financial performance. It provides a more accurate picture of your company's financial performance than simply tracking cash flow. By matching revenues with the expenses incurred to generate them, accrual accounting offers a clearer view of profitability and operational efficiency. Consistency. This principle requires you to apply accounting policies and methods consistently from one period to the next. This consistency allows for comparability, making it easier to track financial performance over time and to identify trends. This ensures that your financial statements are comparable over time, allowing users to track your progress and identify trends. Consistent application of accounting methods enhances the credibility of financial statements and helps stakeholders make better informed decisions. These principles are the bedrock of reliable financial reporting. They provide a framework that ensures the financial information presented is both accurate and consistent, which is essential for maintaining trust and transparency in financial reporting. They ensure that your financial statements provide a fair and accurate representation of your company's financial position and performance. By adhering to these principles, businesses can build credibility with investors, regulators, and other stakeholders, fostering a stable and trustworthy financial environment.